Thank you. Me again. Welcome to the second panel, where this time we're going to focus on Europe exclusively. I hope you all heard the discussion that we've just had, which was a little bit focused on Europe and had some good transatlantic differences of opinion on the outlook for Europe. So we'll see if those get continued this time. But I want to drill in a little bit more into the detail of what's actually going on right now in Europe, and particularly how much we can expect from the asset quality review of the European banks that has just been started by the European Central Bank. And this sort of nexus for the last few years, we've heard again and again that the kind of bad cycle between weak banks, weak sovereigns, is the heart of the financial fragmentation, which is the heart of Europe's problems. And is Europe really getting to grips with that? And so I thought we'd start with that. And maybe we'd start with you. Give us a sense of, is it for real this time? I mean, the Europeans have had 2 stress tests of their banks before, and both of them were frankly a disaster. They didn't really restore confidence. No one took them seriously. Is this time different, as they say?
Well, in Spain, we have a saying in Spanish that says, a la tercera va la vencida, which means the third time is the good one. So by that standard, I guess this time is the good one, I think that there are 3 reasons to think why this may be the good one. The first one is because the other 2 were not successful, so you don't get that many opportunities, so you might as well get it right this time. The second one is because there's a whole new architecture that's been put in place that wasn't there before, which is this idea of constructing the banking union. Prior to that, there was no banking union being put forward. There was no project over the medium long term. It was just basically a reevaluation of the banks as they were with the financial context that we had at the time that was expected to continue indefinitely, and it was already being under a lot of tension. And the third one, which I think is very important, is that at the core of this evaluation process that we're going through, or that we're starting now, we're going to be going through over the next year, is the ECB. And the ECB, is arguably the most credible supranational institution in Europe right now, has a reputation that it has to keep. They're very aware of that reputation. I think they'll probably be willing to try to push as much as they can and as hard as they can to make sure that they don't get a hot potato at the end of this process. Because, if there are dark things hidden somewhere and they don't show them up over the next 12 months, more likely than not, afterwards, they will be in charge of supervising them and they will have to take the hit for that.
That's absolutely right, and that's a very, very strong set of reasons why we might take this one, might be a bit more hopeful about this time. But Nicolas, and I think it was Jörg Asmussen who said that this was the third and last chance to restore confidence in the
Another senior German central banker said three strikes out, which was another popular expression to describe it.
We can think of endless metaphors, but it is true that for the European Central Bank, they have skin in the game, as they say. If they don't do it properly this time, they're going to be stuck with this. That said, there's also the argument that if you do the asset quality review too well, and you come up with large capital shortfalls, we don't really have a backstop in place yet. We have sort of intimations of one, but we don't really have a backstop in place, and therefore concerns about the lack of confidence that might create will in fact push policymakers, or even the ECB, to look less carefully under the covers than they otherwise would.
Well, first, I basically agree with Jose Manuel's assessment. I think there are good reasons to believe this time will be different. And one way to think of it is that the last stress test was directed by the European Banking Authority, the EBA. One could argue that it cost the EBA its reputation. But okay, assume the reputation of the EBA is destroyed, and not for lack of good work at the EBA, just because they didn't have the mandate, they didn't have the institutional strength. EBA down, no big deal. It's not a sea change for Europe. If you assume ECB down, big deal, because it's a monetary policy authority. So the stakes are much higher this time because it's the ECB. It's not just that the ECB is a stronger institution. It's also that Europe has much more to lose from a failure of this exercise. Now, on your question about failure, about backstop, sorry. Maybe I'm obsessed with failure. We have backstops. The Eurozone is solvent. There is money in the system. The question is, how is this money potentially channeled? What are the decision-making processes? Who pays for what? So it's a political question. It's a burden-sharing question. But the question is not there is no money to backstop the system. The money is there.
No, the question is, are the Germans willing to pay?
No, even the national budgets. I mean, if France has a problem, there is money in France. Spain has market access. Spain will have exited its program when we talk about the results of the comprehensive assessment. Italy has market access. So basically, the only countries which don't have market access are ones which are relatively marginal in next year's comprehensive assessment, because next year's comprehensive assessment is system-wide, and this is what makes it distinctive. But then the question is, is there a risk of losing market access? And how is the money handled, especially in political terms, given the concerns of the public opinion and taxpayers? So these are the questions, and there is a third question which is at least as important, which is the practice consistent from one member state to another, or do you have something like bail-in in Italy, bail-out in Germany, which of course would reinforce, not mitigate, the famous vicious circle between banks and sovereigns? So all these questions at this point are unanswered, and this is why the ECB is insisting on backstop, which is actually code for them to say, we need a framework here, we need a process, we need to know how decisions will be made. But the problem is not the availability of money, it's how it will be shared and spent.
Do you agree with that, Bruce?
Well, Jose Manuel and Nicholas make a lot of very good points here, and so I would agree generally that the ECB on their watch is going to do what they need to do to make sure this AQR exam is the real deal. So let's just go back and just kind of make the comparison, because you're asking for the comparison. So first of all, under the auspices of EBA, it was booted over to Oliver Wyman, who isn't exactly who I would go to if I want a stress test of individual banks throughout the entire European banking system. I'm with you completely, Zanny. It was a joke, right? And we laughed at it when we saw the results, right? And the first thing that you want to consider when you look at the stress test is it's a stress test. And what is a stress test exactly? What did they do? They looked at, okay, what happens if inflation goes up? What happens if your GDP contracts or employment goes this way or that way? That was their stress test. It was a macro stress test as opposed to AQR. What does AQR stand for? It stands for Asset Quality Review. So we're going to look at loan by loan by loan and evaluate the quality of these loans. Do you know how many loans are sitting on the balance sheets right now in Europe that are non-performing? The answer is 1.17 trillion euro. And they're going to look through the balance sheet of the European banking system and evaluate these banks and see what the credit composition is and what the credit worthiness of these banking assets are. So the big picture is this. The US economy is a $16.2 trillion GDP. It's the size of our GDP. The total banking system here in the US, including JP Morgan, Wells Fargo, Bank of America, all 7,000 plus banks, the total banking system is slightly less than a 16.2 trillion. It's 15 trillion in assets. So about 92% of GDP is the size of our banking system. So now let's go to Europe. Do you want to start the 28 countries that represent the European Union or the 17 countries that represent the European Monetary Union, the currency bloc?
Let's stick with the euro.
Okay, so you start with the euro, and that's a $13 trillion GDP for 17 countries, slightly less than the US's GDP of 16.2 trillion. What's the size of Europe's banking system, the monetary union banking system? Is it bigger than that 13 trillion or smaller? A little bit bigger. Try 4 times bigger. Try 42 trillion in assets. So the size of the banking system in Europe is way too big relative to the size of GDP. And every bank, whether the government or the bankers want to admit it or not, is a contingent liability to that government. If the bank fails, the government takes it over to protect the depositors. That's just the way it is, right? So when you think about it for just a minute, just the big picture, right? They need to shrink the banking system. You can't do that during the crisis. During the crisis, can you really run a stress test to really impact the banks, to make the banks, when they need to just survive during the crisis, when people are worried about the currency surviving and the sovereigns making it through and being able to fund themselves, right? And the economy, which is contracting due to austerity that's being imposed to bring the balance sheets of the governments back in place. So now we're into more of a stabilization period. We're not in a crisis mode in Europe. The euro is now back to being a reserve currency. It trades at 137 versus the dollar. The sovereign crisis is mostly behind us. Greece already defaulted. Their debt comes due 10 and 30 years from now, right? Ireland couldn't fund themselves at 2%. They fund themselves at 3% today. So the sovereign crisis is mostly behind us, although they have lots of issues to deal with. The banking crisis, thanks to the great job the ECB did, is now in more of a stabilized footing that they can fund themselves. And Europe, for the first time, is coming out of a recession in 2 to 3 years, and is starting to grow anemically, but it's starting to grow. And so now they can go about fixing the banking system. And who's the right one to do it? Of course, the ECB, not the EBA punting it to Oliver Wyman.
But the question is, that's a superb explanation of where we've got to and why we're here. The next question, though, is, okay, what is the ECB trying to do? Because you say the size of the banking sector needs to be shrunk. You made the point, Nicolas, that there was plenty of capital ready to recapitalize banks if necessary, that it wasn't an issue of the amount of money. And just from watching it, there seems to be a question of, the conditions under which banks will be recapitalized or not. Who has to take a hit first and what the rules will be for that. And then it's, if there is to be recapitalization, is the relevant state capable of doing that? And I want to turn to, yes, maybe with you first.
No, I actually would like to make a couple points. One coming back to a comment that you made about, the Germans' willingness to pay. I think part of and this is a side point, but I think it's important, part of the problems of this crisis is that it's been put in such a caricature.
That's what journalists do. That's our job.
By countries, But this has an impact because every single German citizen thinks that they're a net creditor and thinks that they're actually paying for this crisis. And every single Greek citizen thinks that they're a net debtor and thinks that they're getting bailed out by the Germans. And that's actually not a good characterization of the crisis.
That's a fair point.
Because, to a high degree so far, most of the bailing has been done, or most of the support has been done by all countries on an equal grounds. So there's no real, any additional explicit burden share. There may be potentially, if everybody defaults at the end of the day, that the only one that's not defaulting is the AAA country. That's very important. Second, most of these packages have been with the guarantee of the solvency of the national country receiving the money. So at the end, it's those citizens, the ones that are really bearing that burden. And most of that money has been transferred from private creditors in Germany that have gotten, or in the surplus countries that have gotten full return for their payment into sovereign loans. So, this is just a small qualification on the context. Now, coming back to your comment, I think Bruce is absolutely right, that there is a very high dependence on the banking sector in the financial industry in continental Europe. So most of the credit channeling is done through banks. That makes the banking system particularly important in continental Europe. That makes the banking assets so much higher than in non-continental Europe, in the US, but also the UK, because basically it's much more intermediation through financial markets than not banks. That's why the banking union itself, I'm fixing that, is so important for the appropriate channeling of credit into the economies. Because there's absolutely no way in economies in the periphery with a high preponderance of the small and medium enterprises that you can get any reasonable financing going if it's not through the banks. So getting the banks fixed is much more important there than anywhere else. I also want to put in perspective, this exercise is taking 130 banks, which are a lot, which are the large banks. There are a small percentage of the over 5,000 banks that are in the euro area, the large percentage of the assets. But it's much, much larger exercise than any other exercise that has been built in any other context. So, we should be aware that the challenges are daunting.
Do you, Nicolas, and you can respond too then, do you think that the expectation is that once regulators, once the ECB looks under these banks, looks into their balance sheets, looks under the carpet, that they will find, that they will be pleasantly surprised that actually, the black hole of European banks is not nearly as grim as some of us think? Or, in fact, it could be an awful lot worse? Because if you look at, you see very different estimates of quite how bad this problem is, and obviously it's contingent on what expectations you have for the economy, but what's your sense as someone who really thinks a lot about?
Well, if there was no problem, if there were no proverbial skeletons in the cupboards, we would have had much more transparency and disclosure now. And so there's a smell test that is not passed here. So there is a bad smell in the system, and we don't know where it comes from, but it's definitely there.
Do you have any suspicions about where it comes from, what countries?
You know what? No. And,
I think it comes from supervisors.
And
not doing their job. From supervisors not doing their job.
No, but I'll make a backward-looking point and a forward-looking point. You know what? I don't have a suspicion because the market is all over the place. And there are very well-informed, smart people in the marketplace who think the problem is Spanish banks, Italian banks, French banks, German banks, and there are equally informed, equally smart people who say the problem is not Spanish banks, not Italian banks, not French banks, not German banks, depending on who you ask. And when you look at the market estimates of what the general capital shortfall is, you have any number between 15 and 300 billion euro, or even perhaps more. So there is no Gaussian distribution of estimates here. It's all over the place. So at this point, we don't know, and this is precisely why we need this assessment. It's precisely why we need the ECB to bring the transparency that is not there. So now let me make a backward-looking comment and a forward-looking one. The backward-looking comment is, why are we in this situation where we are so much overbanked, where the banks are so big compared to the European economy? Let's do a bit of introspection here, because this debate hasn't really happened. What led us to this situation? Well, I will argue that what led us to this situation is that we have been through a phase of market integration with separate banking policies, country by country, and the incentives were entirely distorted. Basically, the policy framework we had was putting incentives on national authorities, including banking supervisors, saying, I want the biggest banks, because I want my banks to win the integration and consolidation games. I want to be consolidator, not a target. And this reasoning, which is perfectly normal in a private sector bank-by-bank setting, became a national thinking. And so the combination of national banking policy frameworks and market integration through the single market and all the things that happened in the 1990s became extraordinarily perverse. And this is why you see that the buildup of leverage in the banking system through the decade before the crisis has been even more marked in Europe than in the US, and God knows that in the US it was perverse. So that's the backward-looking point. The forward-looking point is, okay, who will win this tug of war, right? You said member states basically want to put the dust under the carpet. ECB wants the carpet to be flat. So is it possible to square that circle? I don't think you can really, given the quantity of dust. I think there is just too much dust that you would have a happy middle ground. So basically, we'll have an escalation between the ECB and the member states to simplify an extraordinarily complex political story. This escalation will happen. I make a bet that this will bring you more market volatility in 2014 than we've seen in 2013, in spite of very significant shocks. Remember, Italian elections, Cyprus, emerging markets, US fiscal escalation. None of this moved the European fixed income market that much. I bet you that we will have more moves next year because of this escalation between two very powerful forces, immovable objects. The member states don't want, basically want forbearance. Unstoppable force, the ECB cares about its credibility. How it gets resolved, I don't know, but I know it's a big game. Because if the ECB loses, this really puts the strength of the Eurozone into question. If the ECB wins, it can be a very beautiful start of a story where confidence gradually comes back to the banking system, and then you can have a pickup of growth, hopefully. Of course, banking stuff is not enough. You need structural reform. You need a lot of other things, but I think this is really a big juncture for Europe. Sorry.
Zanny, the key to all this is very simple. And the word begins with the letter T. Time. And so the whole key is just extend the time. Let's all settle down. There's a big issue out there with the banks being too big. We just need time to grow out of it. It's simply time. That's all it is.
Isn't that a sort of Japanese-ish approach?
You know, it is, and that's Europe. But that's Europe, okay? Europe will be the new Japan from that respect, because there's going to, when you have a banking system that's this large, that needs to downsize, by the order of magnitude that we're talking about, how can the economy grow by anything more than 1% a year? How can it when the banking system itself is shrinking? When debt to GDP ratios at the government are 100 to 120%, and your fiscal deficits are above the Maastricht Treaty of 3%, and they need to impose levels of austerity, granted today it's more pro-growth oriented, but levels of austerity that are not necessarily pro-growth, how is the economy going to grow by much more than that when you have a shrinking population, when you have a banking system that's too large? So what the ECB and the whole banking community needs is simply time. You want to look at one reference? Look at the United States, and not during the 2008 crisis, because that's not the right crisis to really refer to. The right crisis was the savings loan crisis in the 1980s. And if you go back and study that era, when the United States started with, you know, back then, about 13,000 banks and savings loans, and ended the decade with about 9,000 500 and closed 3,000 and change during that tenure, right? You had hundreds of banks closing down every year. So if you look at that bar chart, 84, 85, 80, all the way out. And what happened after the savings loan crisis? No bank sold. It doesn't happen in a crisis. It never happens in a crisis. You need the markets to be stabilized first. You need the regulators to be organized and the markets to be stabilized. So what happened next is in the third quarter, I believe it was the third quarter, I'll have to check because it was a long time ago, of 1989, the US government set up something called the Resolution Trust Corp, the RTC. And they populated this company, which is state-owned, which is government-owned, with like 3,800 employees. And they went about the biggest asset disposition program that the United States had ever been. And when was the RTC closed down? I'm guessing 1996, because that was the year.
Extremely good
So that's 7 years after, the real crisis. So what has Ireland done? They've just set up NAMA, which is the National Asset Management Company. Spain set up Sareb, right? Germany's working, and by the way, which country has the greatest number of NPLs in the whole entire European banking system? Germany. Not Spain, not Italy, but up north, the strongest country of them all. So there's a lot to clean up. They're going to clean it up. There's going to be no crisis next year. They're going to clean it up. They're going to do the stress test. They're going to sweep in the bad assets to these national companies, close down the bad banks, good bank, bad bank it. It'll take time to do it. And it's not 1 year. It's 7 years.
And do you think that the individual countries, as Nicola alluded earlier, have the fiscal capacity themselves to do it?
Yes.
I mean,
100%.
Okay, that's interesting. And
No government is going to fail on this basis.
Any need for joint European money?
100%. You need to bring a banking union in place. You need to put together the equivalent of the FDIC, where there's an insurance program where no deposits across the region, so money doesn't leave Italy to go to Germany and so forth and so on. So it needs to be put in place. It's not going to happen anytime soon because Germany won't allow it. Why won't Germany allow it? Because they're not going to be on the hook for the $1.17 trillion of NPLs that's in that system until you clean up all that crap. Clean it up, and then they'll form it. That's what's going on. So what do you need? That word that begins with T. That's what you need. Because time, with Fed funds at 50 or the bank or the ECB lending at LTRO rates that are crazily low, and earning a nice rate on what's performing, you'll be able to earn your way out of this problem if you're bank.
But if you grow sufficiently slowly over that time, then the problem keeps on getting worse.
Okay, so then do it faster and then go into a recession. Which one do you want?
I'm going to defer to you.
It's the lesser of two evils.
Before I
and you're smart enough to know that answer.
Just
Sandy.
one more question to you, because I can't resist asking it after Nicola says that the smart money is all over the place and where the problem is worse. As a member of the smart money, where are you looking for the best bargains?
Do I have to tell you?
Yes.
Okay.
So we're among friends.
Off the record? No. So I know there's a lot of record out there. So. Look, there's 3 golden opportunities to play in Europe if you're a distressed credit manager like Marathon. So number 1 is the greatest asset disposition exercise in any banking system in the history of the world, ever. You look at the RTC assets that were sold as a percentage of GDP, or an absolute number, and it's dwarfed by what's going on in Europe today, number 1. So are we into the banks buying billions and billions out of the banking system at distressed levels? Spanish NPLs at 3 cents a dollar, German first, mortgage, income-producing property debt, senior mortgages in the 40s. I mean, it's a great opportunity for us to buy assets, number 1. Number 2.
But you haven't started, right?
It's only started because the banks weren't selling a year ago in the crisis. They've just started this program. And it's a multi-year opportunity. Number 2 is the right-hand side of the balance sheet. Assets equal liabilities plus shareholder equity. That whole right-hand side, the banks all need to come in compliance with Basel III, the debt itself, right? And so that's a wonderful opportunity. The banks doing the recaps and be Basel III compliant, and us selling back debt to the banks directly, as well as recapping the banks because they all need equity capital, or a lot of them do. And number 3, while the default rates for high-yield companies here in the U.S. is running around 1.4% currently, the default rate, the 1-year trailing default rate. In Europe, that number is around 4 to 5%. Why? Because Europe's been in recession, and debt's a fixed stock. EBITDA has declined for a lot of these companies, and so these companies are having difficult financing themselves in the marketplace. Banks aren't lending, and so you see default rates considerably higher for some of the non-investment grade companies. So the corporate restructurings that are happening, the bank restructurings of the balance sheet, as well as the recaps of the bank, represents, I think, a wonderful opportunity for the asset management community that really has distressed debt, long-term locked up capital that can invest in these opportunities.
And presumably, once you start investing, a wonderful opportunity for Europe too. I'm suddenly realized how little time we've got left, so I better open up the floor to questions. And if there aren't any, I've got lots more, but there must be some. No one wants to know how to make enormous amounts of money in the distressed debt space in Europe? Okay, well, if there really aren't any questions, then I'm going to spend the next time asking you to respond to that. I mean, is what the picture Bruce paints not the sort of biggest reason to be optimistic about Europe? But that's what you need. You need this stuff off the balance sheets, and you need people like Bruce buying it fast.
I think that's fundamentally right. The point that will somewhat be deviating a little bit from what he says, you don't just need time for the sake of time. You need growth with time, and you need the time to do the reforms that are necessary, like the asset disposition, some of the reforms that will help you engage in that growth potentially in the medium term.
And is this the asset quality review enough to do that? I mean, one argument is that actually you need more than that. You need more bankruptcy reform. You need to do much more to make the European legal environment more conducive to asset
You're getting the bankruptcy reform, by the way. They're forming, UK's always had strong bankruptcy laws, but look at the bankruptcy reform that's happening in Germany, Italy, Spain, and elsewhere, and it's becoming more and more robust. We've been operating in those countries for years and years with the old bankruptcy regime, but the new bankruptcy regime is much more creditor-friendly, and so that reform's happening.
I basically agree that this will be a humongous wave of consolidation, restructuring with enormous opportunities for the smarter investors to make pots of money. So I think this is true. Now, you need the politicians to allow it to happen. And for the first 5 years of this crisis, from mid-2007 to mid-2012, basically politicians didn't allow this to happen at all. Then in mid-2007, they made the landmark decision, better late than never, we'll go for banking union because otherwise we die. And it takes them more than 2 years to do the first step of implementing that, which is not by far the last step, which is putting in place a single supervisor. I think this potentially can unlock the things that Bruce is talking about. So that's the good news. The bad news is we waited a long time. And we put in a way the cart before the horse because we said we want the single supervisor to be in place before this humongous wave of restructuring and selling and buying can happen. But that's because of the other T, and the other T is trust. And basically, there was no trust in the system, and so the way Mrs. Merkel squared that circle, for better or worse, was to put the ECB in charge of supervision before anything substantial with real money can happen. So here we are. I'm optimistic on next year. I think if I look at the coalitions that can form around the ECB, around the recalcitrant member states, at this point, I would say the ECB wins, but I'm not sure.
So
and I think it will be several steps before we know for sure that the scenario that Bruce is describing.
I'm not too focused on what Nicholas is saying with the winners and the losers.
We have a deadline.
It's going to move forward, period.
Well, it hasn't moved forward a lot in 5 years.
ECB is the stronger hand.
I was just going to add to what was being said. I think that there is absolutely no doubt that there is a very high commitment at the highest political level, and this is my understanding, that the banking union will go forward. That doesn't necessarily mean they're very happy about giving the impression that they're bailing out all banks, or that there are huge transfer of money across countries being down overnight without a very well justified reason, or a very well trade-off, which is basically more sovereignty, reduction or more conditionality in the money being provided. But I think that the highest level of commitment does exist and the highest level of perception that the banking union is going forward.
Thank you. This has been one of the most upbeat conversations I've had about Europe for a long time. And I love the two T's, the trust, the time, and now I'm going to add a third one, which is actual tea, or at least refreshments outside after this panel. Thank you all very much. And I do believe just outside there are refreshments for all of you. Please remember to tweet us your thoughts on what you've just heard and been discussing, #BW2013. And when we come back, the CEO of American Airlines, Thomas Horton, and Roger Altman of Evercore will join us on stage. Thank you all.